Hello, I'm Jason Dynison with another MyCPE Shorts. Thanks so much for joining us. Let me get the screen sharing on and we'll walk through the latest news from around the accounting and tax world, not just in the US, but around the globe. So we start with the White House looking to get rid of around 60 accounting rules for government contractors who are like putting in bids for government work. So for a long time now, over 50 years, contractors putting in bids with the government had to use cost accounting standards. And a lot of them then had to issue financial statements, under generally accepted accounting principles as well, which meant two separate sets of record keeping, two separate reports, or two separate reporting standards that had to be met. And while GAAP got closer to cost accounting standards through the years, they're not exactly the same. And the other thing is, it still, you had to issue two different reports if you were a contractor or a company looking to, when I say if you're a contractor, that makes it sound like you're just some guy, the local handyman or whatever. It's really companies wanting contracts with the government. So this is estimated to cost around $750 billion in annual federal contract spending just to maintain compliance. So now the Cost Accounting Standards Board has proposed to eliminate more than 60 rules that they call unnecessary and redundant and lean on GAAP in three core areas instead of having separate federal standards. And this goes along with the SEC saying that they want to focus more on like big ticket crooks, as the director says, and not nickel and diming firms on technical missteps. Speaking of accounting standards, there is a decent number of jurisdictions, government entities around the world that use cash method accounting, not accrual method, but the latest numbers show a big change in that. And more of these entities are switching to accrual. So, as the article says, cash is the lonely gas gauge, while accrual is the full instrument panel. A lot of small businesses, now we're talking about government books, but for businesses, small businesses, the local mom and pop stores and such use cash method accounting, and that's just fine. The bigger you get, whether you're a business or an entity like a government entity, accrual tells you more information about really how you're doing financially. So, worldwide, the public sector is moving away from cash to accrual. And if we look at a chart here, in 2020, only 30% of jurisdictions used accrual method. That's risen to 42% now and is projected to be 56% by 2030. And many of these entities are also adopting certain international standards as well. And so, why are they doing this? I mean, some of it's because of just COVID left a lot of holes in budgets. And cash method reports basically what's happening moment to moment, but accrual forces you to have to account for things like debts and pension obligations and such that might come due next year or sometime down the road that you have to plan for. Accrual method. Accrual method basically forces you to have to account for those things so you can plan for it. Now, speaking of pensions in the United Kingdom, England, the Office for National Statistics has confirmed a 4.7% increase in the state pension starting in April of 2026. That could amount to £500 a year. If you do a conversion on that, the pound is stronger than the dollar. So, I mean, that would probably be like 550 or more US dollars. Now, that's nice. However, the personal allowance, people could start edging closer to the personal allowance in the UK, which is similar like to the standard deduction. It's like an exemption amount. Think of it that way. So, you can see the article tells us state pension increase will bring annual payouts within just £35 of the tax-free personal allowance, which could kick people into owing taxes. So the government in the UK has what's called a triple lock guarantee, where state pensions will go up every April by the highest of three different measures: a measure of inflation, average wage growth, or 2.5%. And this year, the larger of those is wage growth at 4.7%. So that's where the increase amount comes from. So, um, the tax man is always there. That's true wherever you go in the world. The tax man is always lurking in the shadows, waiting to get you. You can't really ever truly avoid taxes. So that's just a little bit from the UK. In some acquisition news, and then we'll switch into some US things with um, tax pros and accounting pros switching careers, and then get into projections for 2026 and Kiddie tax. The firm BDO has announced that it's acquiring the Mississippi-based company Horne LLP, for around $300 million, which will be the largest expansion in BDO's history and will bring their total revenue to around $3.2 billion and also give them greater market reach, as this will place them in 7 southern states. Horne's specialization is in disaster recovery and government services, so it'll open up new revenue streams for BDO. 1,300 employees and 30 principals from Horne are coming over to BDO. Well, would you believe that there are some accounting professionals switching to being travel agents? Which seems kind of random, I guess, but this article talks about how that's actually pretty lucrative for folks who have done this. And, the travel agent world is different now, I suppose, than it was even just a few years ago with the internet and AI and people shopping for deals. I mean, that's been the case the last 10 or 20 years, I suppose, but a lot of people still use travel agents. And, the topic of burnout in accounting and finance, the long hours, the compliance pressure, the ever-changing rules. I have my own personal experiences with burnout that I could talk about. It's so common that accountants get fed up and they just walk away. I haven't done that, obviously, but I know people who have. I know a guy who he was an EA and an EA in Kansas City, Missouri, 25 years of experience. He was a tax pro preparing around 400 returns a year. He had a storefront location. And one tax season, he just snapped and he was like, I'm done with this. And he filed extensions for people who had given him their stuff. He gave them their stuff back and said, I'm not doing it. Goodbye. And he went and started working as an engineer on the railroad. So this happens. Now, here, people are switching to being travel agents in some cases. So Lisa Reich was a forensic accountant. She went through a divorce and all the hours of being an accountant and the burnout. And now she says she's working half the hours and making quadruple the salary. Amira Bixby spent 30 years on Wall Street and then just walked away and launched her own travel advising company. As she says, when you can work from anywhere, your life changes drastically for the better. So it's not just about money, it's about lifestyle. And I will say from my own experiences, COVID for me changed a lot of things about like working remotely and, you know, making memories and doing things now and not waiting till, you're 75 years old. So the travel agency field is not dying. In fact, travel agent on LinkedIn ranks among the 5 fastest growing professions, with a 50% jump in the last 3 years and big spending. People who have money, they don't want to shop around on the internet trying to get airline deals and plan vacations. They'll pay a travel agent to do it for them. There's a lot of there's a lot of demand in this industry. And accountants and finance pros bring skills to the table that are needed if you're going to be a travel agent. Like transfer pricing and tariffs. So U.S. subsidiaries are having to rethink their pricing strategies due to the tariffs. These are impacting the profitability of entities involved in intercompany deals. So transfer pricing has to do with like international companies doing things with each other. Well, tariffs could be involved on those transactions. And basically, what this article is all about is just that this is something that companies are dealing with, and who's eating the tariff costs, who's deducting it. It could be a red flag for the IRS, depending on how it's set up. All right, Bloomberg recently came out with estimates of 2026 tax brackets and a bunch of other stuff, not just tax brackets, but basically projections for 2026. So the IRS has not released the inflation adjustments for 2026 yet. That'll be coming somewhat soon, but in the meantime, the tax experts at Bloomberg have run their own calculations on what they think the numbers are going to be for 2026. And I'm not going to read all of this stuff up here to you, but this just shows the projected tax brackets according to Bloomberg. I do want to go down to standard deduction. So the standard deduction for 2026, according to Bloomberg, will be 32,200 for married filing jointly, 16,100 for single or married filing separately, and in the middle at 24,175 for head of household. Remember, this is not official. This is what Bloomberg projects. A few other things. Gift tax exclusion is set to, Bloomberg says, stay the same at 19,000. Estate tax exclusion, we do know that for sure because the big beautiful bill puts the estate tax exclusion at 15 million for 2026. So we know that for sure. And then one other note is kiddie tax. One of those things to just remember as a tax pro that kiddie tax is lurking out there anytime that you have a taxpayer whose child or dependent up to potentially the age of 23, well, age 24, it goes away at age 24, you could get hit with kiddie tax. So this has existed for a long time, where Congress put in place the kiddie tax, which says investment earnings or unearned income of children is taxed at the parent's marginal tax rate. And what Congress is trying to do is make it so that parents with a whole bunch of investments can't just like offload and gift those investments to their kids, like their minor children whose income is zero otherwise. And so all of those investment earnings are taxed at a way lower rate than the parents are. So that's the goal of kiddie tax, or basically any unearned income above $2,700 could be taxed at the parent's marginal tax rate. That's the kid's unearned income. Now, a lot of times we think of kiddie tax as being on investments, interest and dividends and capital gains, and that's true. But one thing to be clear on is the law doesn't say investment income. The law says unearned income. So that means anything other than like W-2 wages or self-employment income could be considered unearned income and subject to kiddie tax. So just something to be aware of. I mean, that $2,700 mark, a lot of average folks, even if their kids have investments. I mean, I have clients whose kids have investments and they bring the 1099 packet in and they have like $30 of interest or dividends during the year. You don't even have to file a tax return for that. You're certainly not subject to kiddie tax. But it is something that's out there. Don't, as they say nowadays, don't sleep on the kiddie tax. Well, that'll do it for this edition of MyCPE Insights. I'm Jason Dynasson. Thanks so much, and we'll talk to you again next time.